So we're going to divide up. You guys are all going to be, let's say these 3 rows are here are going to be on your team where you saved the 1,200. You 2 rows over here are going to be the savers that have saved more, the 6,000, okay?
Ew.
So everyone's going to think about this for a minute. Our lease period's ended and we decided to go out and start looking for houses. And we find one that we love. You can go online and look at houses. They're all posted up there. And we find a really nice one we like where we're allowed to paint the walls whatever color we want and have as many pets as we want, and we want to buy it. So we start going to different banks. That's the first step. You're going to want to shop around to the different banks because they're going to offer you different types of loans. And some banks might say we're going to charge you less interest than others. And that's important. That's what you want to do. So there's different amounts you can put down. So for you guys on the 1,200 side, which is these rows over here, you don't have a ton to put down right now. So let's say you're going to take out a certain type of loan here. And we're going to have to pretend for your guys' sake, because most banks won't give you a loan without putting at least 3% of this purchase price down. That would be a minimum. And if you get this type of loan from a bank, it's backed by our federal government. So the United States government says we're going to let first-time home buyers and some people buy houses with very little money down, a 3% down. And in order to do that, they're going to charge you extra interest. So you're going to be paying more back in the long run, but it allows you to buy a house sooner when you don't have as much saved. Are there any questions? I know this is a lot of math. Yes?
Like you said, you gotta pay back like a monthly mortgage.
Mhm.
How much do they have you pay? Like
I'm going to show you that right now. So let's say that we go on this side and we're going to put down 3%. Well, 3% of 150 is higher than we even have saved right now. So our parents are going to give us a present and say, we're going to help you get started, okay? Because we have to. Because we don't even have enough to put 3% down.
Make sure you're
So-
nice to your parents.
So you be nice to your parents because someday they might need to help you. So on this side, we only got 1,200 in our savings, and we need to get to 3% of 150 is going to be here. What do I have? $4,500. So that's the minimum of your down payment that the bank would say, I want you to give me $4,500, and I'm going to give you a loan for the rest. Okay? So our parents are going to have to step up and give us some serious money here to get to this point. So let's say we get a gift for that much. So we're able to get together our down payment money, and the loan or the bank says, okay, I'm going to give you this loan based on this amount. So you've put down a small down payment of 3%, and the only way to get this type of loan typically is to go through your local bank. So let's say we've gone to KeyBank, and then they've said we can offer you what's called a FHA loan, where there's going to be less down payment money, but you're going to have to pay more insurance on that. Why is that? Because the federal government's taking a chance on you and saying, I'm letting you have this house. You didn't have a lot of money to take down, so you're going to have to pay some insurance back to me in case you can't make your monthly payments or you default, okay? So that's what's called mortgage insurance. Not every loan's going to have that, but if you don't have a lot to put down, your loan typically will have that.
So you mentioned that 3%.
Uh-huh.
Is that just something more recent that allows people to buy a home? Or what's like the recommended?
The recommended
percentage
is going to be
down?
to put 20%.
20%.
down. And we're going to get over here and do that on this side, and our parents are going to have to give us a lot more
Okay.
money.
Sorry if I
No, that's
ran you
okay.
out of order.
No, you're fine. Either they're going to give us a lot more money, or we're going to have rented for longer so that we could keep putting more money in savings until we have enough to get up to that. I mean, and this is a standard rule of thumb. A lot of people want to put at least 10 to 20, but most banks will say if you want to get what's called a conventional loan and not have to pay that extra insurance on it, you're going to want to put 20% down. So in this case, we're gonna go this way though, so we're gonna go through right now and see what your monthly payment would be if you go this route. So for the bank,
Just hit that undo button. It'll bring it up.
I'm not used to these.
Oh, that's all right. I know they're so fun.
I know. So for this one, what do you guys think? You've got to pay the bank back. You're going to put this much down. So you're going to borrow from the bank. You're going to subtract out your down payment. We're going to end up borrowing from the bank in this scenario. Your loan amount, and we're going to simplify this a little because there's some other costs involved. But we're going to simplify and say we're going to end up borrowing from the bank once we take into account our down payment. 1,000. So that's our loan amount. We've subtracted out our down payment from there, and we say, bank, here's my down payment of $4,500. The house is $150,000. I need to take out a loan of $145,500. So, guess how much you're going to pay the bank back. Today's interest rate, right today, for most banks in the area, depending on your credit, so you got to keep your credit score up, and I know you guys talked about that already. As long as you kept your credit good, you haven't signed up for a bunch of credit cards and not made your payments, and if you have a reasonable credit score, you can get an interest rate from the bank of about 4%. So that's what these numbers are going to be based on. And what that means is the bank is saying, okay, I'm going to give you $145,500 to buy this house, but over the next 30 years, you're going to pay me back at a 4% interest rate. And I just want to give you an idea of what that looks like. You're not only going to pay the bank back this full amount over 30 years, but 4% interest amounts to this much additional money that you're paying the bank back. $104,570 just in interest.
And that's over the 30 years.
over 30 years.
So instead of just 150,000, it becomes over 200.
So now your total amount for your $150,000 house has just become $250,070. That is the total amount that you pay for the amount you borrowed. Your down payment's already been made, amount you borrowed, and that's all interest. That's a crazy extra amount, isn't it? Just in interest to pay for your house. You've just added $100,000 onto your $150,000 house. So how can saving more and putting more down help this? And that's what I want to show you. And we're going to go over to this